Hello everybody, welcome to the video on basic interview questions commonly asked to the accountants. In today's video, you will find some important conceptual and practical questions on the concepts of financial record keeping, journal, ledger, subsidiary books, bank reconciliation statement, rectification of errors, final accounts, etc. All these questions will be useful to you whether you are a fresh graduate trying to get your first job or an experienced professional looking for growth. Every moment of this video is very carefully curated and packed with knowledge. So if you are really serious about cracking your next interview, make sure you don't skip any parts of this video. Ready to embark on the journey? Fantastic. Get yourself a notepad and a pen and let's begin. And our first question is, what's the difference between accrual accounting and cash accounting? Which one of the two methods would you recommend? Now see, the main difference between the two methods is in the timing when the revenue and expenses are recognized. Accrual method focuses on the anticipated revenue and expenses, while the cash method recognizes the immediate revenue and expenses. For example, if a company makes a sale in Q1, but the revenue is expected in Q2, accrual method would use accounts receivable and recognize the revenue in Q1 itself. However, the cash method will recognize the revenue only when it is received in Q2. Similarly, if any expenses are made, accrual method would get accounts payable into the picture and record it immediately. On the other hand, the cash method will recognize it only when the actual money is paid. Since the two methods have their own advantages and disadvantages, it is difficult to recommend any one of them. The choice of the method depends on various factors like the size and the nature of the business, reporting needs, legal requirements, etc. The small businesses, proprietorships, businesses that don't rely on credit transactions, etc. usually use cash accounting method for its simplicity and ease of implementation, because their primary focus most often is tracking the cash flow. However, for the large companies that have long-term contracts, different business streams, complex transactions, accrual accounting is more appropriate because it provides a clear picture of profitability. This clarity also helps in tax planning and gaining the trust of the investors and creditors. Okay, so let's move on to our question number 2. What is a voucher? To answer this question, you can say, a voucher is a document supporting a payment made by a business. It is a legal evidence that a certain payment has been made to a specific party or a person. Now see, what's going to happen is most of the candidates who appear for the interview will answer this much only. If you want to stand out, try to provide some extra information about these vouchers. And what's the extra information that you can provide? You can say there are two types of vouchers, internal and external. Internal vouchers are prepared by the organization and signed by the payee. When you can't receive the receipt of some payment, you make a voucher. For example, taxi fare, auto fare, etc. External vouchers are generated from outside the business. That is, the other agency generates it. For example, a debit note, credit note, cash memo, electricity bill payment receipt, etc. Now, you may have cash vouchers, travel bills, wages bills, etc. So, you see, when you provide this extra information, you stand out of the crowd. And you can provide this extra information only and only if you are well prepared. Our question number 3 is, what is a tax invoice? To answer this question, you can say, it is a document that a seller prepares when he makes a sale and supplies the goods. Through this document, he informs the buyer of the quantity of goods sold to him, rates, terms of payments, then trade discount, CGST, SGST, and total amount that's payable. For the seller, it's a sales invoice or outward invoice. For the buyer, it's a purchase invoice or inward invoice. When goods are sold on credit basis, we make a credit memo. Okay, now one of the very basic questions that's usually asked to the candidates appearing for the role of an accountant at a junior level. And the question is, which are the different parties to a check? See, it looks very simple, but trust me, many candidates at a junior level are not able to answer it correctly during the interview. Ensure that you are able to. There are three parties to a check. The first one is the drawer. That is the person who draws the check. That is the one writing the check. The second one is the drawee. That is the bank on whom the check is drawn. So as I said, this is always a bank. And the third one is the payee. That is the person in whose favor the check is issued. Now, the next one is really tricky. Pay attention. What do you know about combined journal entry? See, while making a journal entry, if more than one account is to be debited or credited, it is called combined or compound journal entry. It is also possible here that many accounts have to be debited or credited for just one journal entry. Let me give you an example. If someone starts a shop with goods worth say rupees 80,000, a laptop which is worth rupees 35,000 and some cash that is approximately rupees 30,000. A combined journal entry will look something like this here. Important, pay attention. Moving on to the next question. What is a ledger? A ledger is called as the main book of accounts or the principal book of accounts. Many a times it is also called as book of final or secondary entry. See, through the entries made in journal, you can't tell what amount you spent on a particular type of expense or what is the amount payable to a certain party. So, you make a ledger which contains proper accounts for everything. It is a summarized record that contains all the accounts like assets account, capital account, expenses account, revenue account, etc. Okay, the next one. What do you know about credit balance and debit balance in a ledger? What do they tell you about various accounts? Now see, the second part of the question is really tricky here. Again, pay attention. If the total of the debit side of the account is higher than the total of the credit side, the account has debit balance. If it is opposite, the account has credit balance. A personal account with debit balance signifies a debtor, and if there is a credit balance, it signifies a creditor. Real accounts are the accounts related to assets, properties, etc. Accounts like furniture account, cash account, etc. are real accounts. They always show a debit balance. Nominal accounts may have a debit or credit balance. These are the accounts related to income, expenses, gains and losses. So, the second part, as I said, is really important here. Pay attention. Question number 8. What is a trial balance? Why do you prepare it? See, a trial balance is an abstract of all the ledger accounts as on the given date, showing credit and debit balances of all the ledger accounts. Depending upon the need of the businesses, it can be prepared annually or more often, periodically. A trial balance shows balances of different ledger accounts. It also proves that your books are arithmetically correct. And it also helps you prepare the final accounts. And that is why you prepare trial balance. Now, as we just talked about trial balance, your next question could be, how is gross trial balance different from net trial balance? To answer this question, you can say, in gross trial balance, total of the debit side of an account is shown in the debit column of the trial balance, and the total of the credit balance is shown in the credit column. This approach doesn't disclose the balance of each account, so it is not very commonly used. In net trial balance, only the balances of each ledger account are shown against its name. If an account shows credit balance, its balance is recorded in the credit column and vice versa. This type of trial balance is more in practice. Okay, now the next important thing after trial balance is the subsidiary books. And our question number 10 is about these books. What are subsidiary books? So to answer this question, you can say, for big businesses, it's not possible to record all the entries in a single journal. So you need to subdivide the journal. These special journals that get created based on the nature of transaction are called as subsidiary books or the books of original entries. Some of the important subsidiary books in a business are cash book, petty cash book, purchase book, sales book, purchase returns book, sales returns book, journal proper, etc. Now, go on to talk a bit about the advantage of having these books in place. So, you can say these books let the business save time and make the operations more economic by having specialized teams and taking up related work at one time. They also provide for better internal checks and quick references whenever needed. Okay, now question number 11 is a little tricky. Pay attention. Why is cash book both a journal and a ledger? Now, a cash book records all the cash and bank transactions. It has two sides, a debit side and a credit side. Since the original entries are made to it, it's a journal. And since it contains classified records of all the cash transactions, it's a ledger. Okay, now our question number 12 is again a tricky one. Pay attention. Which of the following can a bank account have? Credit balance, debit balance, or both the above? Now see, a bank account is a personal account. So it can have both credit balance as well as debit balance. Credit balance of a bank account means bank overdraft. This overdraft is a short-term loan given by the bank to the current account holders. It is recorded on the payment side of the cash book in bank column. Question number 13. How will you treat the following in your cash book? The first case is the check you received gets dishonored. And the second case is the check you issued gets dishonored. Okay, so let's answer the question for double entry cash books that are more common. And let's take the case number 1. Suppose you received a check worth rupees 5,000 from a customer. You would need to debit your bank account by rupees 5,000 to record the receipt of the check. So in your cash book, how would you record it? You would record it something like this. If this check gets dishonored, you would need to reverse the initial entry and credit the bank account by rupees 5,000. Let's do that. When you do that, your cash book entry would look something like this. So this is how you would deal with this case. Okay, now let's see case number 2. What would have happened if you had issued this same check and it got dishonored? So you would credit the bank account by rupees 5,000 to record the payment. The journal entry would look like this. Now, if the same check is dishonored, you will have to reverse this entry to debit the bank account by rupees 5,000 and nullify the effect of previous entry. So the journal entry in that case would look something like this. And this is how you would deal with the second scenario. It's a very important question. Pay attention. If you need, you can just try to replay this much part of the video and see this again. But make sure that you are prepared to handle this type of questions in the interview. Okay, so now let's move on to our question number 14. What do you know about contra entries? See, what happens is certain transactions affect the cash account and bank account simultaneously, but with opposite effect. The entries recorded on both the sides of the cash book are called contra entries. Some situations in which contra entries are recorded are, for example, when cash is deposited in the bank or when cash is withdrawn from the bank for office use, bearer check received on previous date and deposited into the bank. All these cases create contra entries. Question number 15. What is a purchase book? Now see, a purchase book is also called a purchase journal or purchase day book, as most of you would know. It is a specialized accounting record that systematically records all purchases of goods or services made on credit for manufacturing or resale. This is important to mention. Consumable items can't be recorded in the purchase book. They are considered to be operational expenses. It helps to keep a track of all the expenses related to procurement. This is the advantage of having a purchase book in place. Each entry in the purchase book should be supported by invoices, purchase orders, or other relevant documents. Okay, this is the legal requirement. A purchase book works on accrual basis. That is, purchases are recorded when they are incurred. All the entries are chronologically sequential. That is, they are recorded as they occur. Now see, the last thing that I talked about, that is that it works on accrual basis or it is chronologically sequential. These are the little things that add value to your answer. And this is the extra information that you can provide in comparison to other candidates, because most of the candidates don't provide these details. And you will be able to provide these details only and only if you are prepared to deal with those questions, right? Okay, now when you talk about the purchase book, the next question is an obvious one, and it is, which book comes into action when you want to return the goods? So when you want to return the goods you purchased, purchase return book comes into action. It is also called as purchase return journal or returns outward book. For every return, a debit note needs to be prepared. The original copy of this note is sent to the supplier so that he can make necessary entries in his books. The supplier also prepares a note. It is called as credit note. Moving on to question number 17 now. What is a sales book? Now see, a sales book, also called as a sales journal, is a book that records all the sales of goods made on credit. Cash sales are not recorded here. If you sell any assets or things on credit, they are also not recorded here. And if the buyer returns the goods you sold to him on credit for any reason, the entry is to be made in the sales return book this time, which is also called as sales inward book. So when you receive the returned goods from the customer, you need to prepare a credit note, which indicates that the account of the person who returned the goods has been credited. This is how the process works, which you must be aware of to talk about in the interview. Okay, now question number 18 is very basic, usually asked, but a lot of candidates get confused here. The question is, what is the basic difference between a credit note and a debit note? So see, the basic difference between the two is that a credit note is prepared by the seller, while the debit note is prepared by the buyer. Question number 19. What type of entries are made in journal proper? So miscellaneous or infrequent transactions that do not have a dedicated journal for themselves are recorded in journal proper or general journal. For example, adjustment, correction, transfer, opening type of entries, they are all made in journal proper. Okay, now the question number 20 that I am getting you here is very important. Pay attention. What is a bank reconciliation statement? What are some common reasons for discrepancies between the company and the bank statement? Now, to answer this question, you can say reconciliation means comparing two records. Bank reconciliation statement is an internal tool used by the companies to compare the balance in its own accounting records with the actual bank account balance. The difference between the two suggests that there are some discrepancies. These may be procedural, accidental, or intentional. Accountants are expected to reconcile the statements periodically, and in case of bank reconciliation, they usually do it monthly at least. The most common reasons for the discrepancies to occur are, the first one is bank charges and fees that have not been taken into consideration. Then there may be some errors in recording a transaction, which may cause these discrepancies. Then lost and outstanding checks, where the check either didn't reach the bank or hasn't been cleared yet, can be a reason. Then the funds which are deposited but not yet recorded by the bank can lead to these discrepancies. Then transactions that appear in the passbook but not in the cash book. For example, interest credited by the bank, direct collection of income or payment of expenses on behalf of the customer, dishonor of check, amount directly deposited in the bank, etc. can lead to such discrepancies. Then there can also be a difference in the date of recording, which can cause a temporary difference in the two records. Any reversal, adjustment, or collection made by either of the two parties can lead to such discrepancies. And of course, it can also be because of some potential frauds. So these are some of the basic reasons because of which these discrepancies may occur. A periodical reconciliation can rule out all these problems. Question number 21. What do you know about IMPS and NEFT? So IMPS stands for Immediate Payment Service. It is an instant payment interbank electronic funds transfer system that's available in India. The service is available 24/7, even on bank holidays. NEFT, it stands for National Electronic Funds Transfer. It is suitable for small money transfers. And in addition to both of these, you have RTGS also. RTGS stands for real-time gross settlement. It is suitable for larger value of fund transfers. Okay, moving on to question number 22. What is depreciation? If you never use a certain asset, will you still need to depreciate it? So see, depreciation means shrinkage in the value of an asset due to wear and tear, passage of time, obsolescence, etc. Unless you charge depreciation to the revenue, it is difficult to determine the actual value of a business, and you can't make a provision for their replacement also. If you don't use an asset, it still gets depreciated. Land is one asset that never depreciates. In fact, it appreciates. Depreciation is charged to P&L account as it is an element of cost. It is a non-cash expenditure and it is a nominal account. So you see, this last bit of information that I have provided here about depreciation is what is going to set me apart from everybody else in the crowd. And how does it come? It comes with preparation. And that is why I say preparation and providing complete answers is very, very important to stand out of the crowd. Okay, now again, a very important and tricky one. If the trial balance agrees, can there still be errors in the accounting records? So see, agreeing of trial balance suggests arithmetic accuracy in your records. There can still be errors in the books of accounts that do not reflect on the trial balance at all. These can be errors of omission, errors of commission, errors of principal, or compensating errors. Let's try to understand this in a little more detail. The first one we discussed was errors of omission. So when a transaction is partially or completely omitted to be recorded in the books of accounts, errors of omission occur. For example, if you fail to record credit purchases altogether, these errors would occur. Because in such a case, neither the creditor's account is credited nor is the purchaser's account debited. The trial balance is not able to disclose it since it is not reflected here. The errors of principal occur due to incorrect classification of expenditure or receipt between capital and revenue. They do not reflect on the trial balance as the amounts are placed on the correct side but in a wrong account. Then, when two errors are made in such a way that they nullify each other, they also do not reflect on the trial balance and they are called as compensating errors. For example, if on one day I pay a sum of rupees 5,000 to Ram and post it as rupees 500 to the debit of his account, and on another day in the month I pay a sum of rupees 500 to Sham but post it as rupees 5,000 to the debit of his account, their net effect will be zero and they will not affect the trial balance. Okay, now coming to the next question. What are one-sided and two-sided errors? So see, one-sided errors affect only one account and they affect the agreement of trial balance. If one-sided errors are located before the preparation of trial balance, they can be rectified by giving a note to debit or credit the account. But if they are located after the preparation of trial balance, they are rectified with the help of suspense account. Two-sided errors affect two or more accounts. They do not affect the agreement of trial balance. These errors are rectified with the help of journal entries. Okay, now the one that is almost always asked. What do you know about P&L account? So see, P&L account is the main account of final accounts. It is prepared on the basis of indirect incomes and expenditures of a business. The credit side includes indirect incomes. When the credit side is greater than the debit side, it is called as net profit. Net profit or loss is transferred to capital account. And P&L account is a nominal account. This is the most basic information that you must know. And now the last one for today, discuss balance sheet. So balance sheet is a statement that shows the financial position of a concern. It is not an account, rather it is a statement. It has no credit or debit side. It shows assets and liabilities of a business. All debit balances are shown on the asset side. All credit balances are shown on the liabilities side. No nominal accounts appear on the balance sheet. So friends, with this we come to the end of this video. And I sincerely hope that whatever we have discussed in today's video is going to help you crack your accounting interview. Very soon I'll get you a video on some tricky interview questions also that are usually asked to the accountants. If you want to make sure that you don't miss out on that video, subscribe to the channel today. If you have found today's video useful, do give it a thumbs up and share it with your friends also. I'll see you very soon with a new video. Till then, bye bye and take care.